Teck-Tjuan Yap, a partner at Freeman Consulting Services. Thank you very much for speaking to Bloomberg today.
Hi Ben, thank you for having me.
So you have a report which says that investment banking fees may be set to rise by the most in 5 years in 2012.
Yes, we expect specifically in Europe the investment banking fees to increase by about approximately 14 to 15% from 2011 to 2012. And this increase is the highest level since 2007.
Why is that rise going to take place?
Sad to say, is driven primarily by the need to raise capital, and because the PE ratio has been the lowest for the last 3 decades. So we see potentially a lot of private equity firms picking up assets on the cheap side. But of course, this will depend if these private equity firms could get fundings, and also the buyers and sellers' expectation could meet. But on the equity side, we probably see a lot of need to raise capital by the banks and some corporations.
What are the risks to this forecast? What things could happen which mean that this big rise won't actually take place?
A lot of this will, of course, depend on the market stability. As I mentioned earlier on, the availability of fundings by banks that provide to the private equities to let them to do the leverage finance buyout.
And what could this rise in investment banking fees actually be worth to the investment banking industry in financial terms?
It could be worth approximately 2 to 3 billion in additional fees. I think it's hovering around 22 billion. This will, of course, depending on the product mix. Of course, the privatization will yield much lower fees from investment banks, although you'll probably see record volume.
And which firms do you see benefiting from this rise?
Potentially, you'll see the European banks if it's driven by privatization. But if it's driven by private equity, you probably might see American bank benefiting because some of these European firms are cash-strapped in terms of their balance sheet, and they might not be able to provide financing required to execute those deals.
And do you think that this rise in investment banking fees may have an impact on hiring? We've seen a lot of job losses in the industry.
Not really, unfortunately, to the unemployed. A lot of this we see access capacity. We predict that with the impact of Basel III, investment banks will have to rationalize the coverage in terms of products, geography, as well as the coverage in terms of the client that they cover. So they probably want to trim down a bit, even further more than what they are doing now.
And how about bonuses? People going to look forward to big bonuses at the end of next year?
That, unfortunately, I don't have any visibility.
Now, this bumper rise in fees won't please the many protesters who are part of the Occupy Wall Street campaign. What do you think investment banks can do to negate the bad publicity which could possibly be attracted by the massive rise in fees which you're predicting?
I think the first thing that they should do is basically to communicate better that unfortunately not everyone who worked on the Wall Street received that type of bonuses. I think it supports a lot of auxiliary industries around it, and also a lot of technical people supporting the industries. So people need to have a better understanding. And as I always say, be careful what you wish for.